What's going to happen to property values as we move forward? If you believe the banks, we're going to have a property crash. But in this week's Property Insider video, Dr. Andrew Wilson is going to give you his forecasts for the balance of this year. And you wouldn't be surprised if they're different from the mainstream commentators. But when you look at his long-standing track record, I believe he's worth listening to. So at the end of today's Property Insider chat, you'll have more clarity on what's ahead. If you want to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so we can inform you each time a new show comes out. We seem to have a new national obsession, and it's even bigger than worrying about who's going to win the football on the weekend. It's called which way are house prices heading next? According to our big banks, Australians got to brace for the worst housing correction on record, as rising interest rates are going to strangle our property markets. And while Australia's economic fundamentals are still strong, consumer confidence has taken a significant hit, and that's affecting our housing markets. Buyers are more cautious and they're taking a wait-and-see approach, while sellers' confidence has become more fragile. So will property values really fall 20% like the banks are suggesting, or 30% as some commentators are suggesting? That's what I want to ask today of Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, in this week's Property Insider chat. And I also look forward to having a talk with him about some of the other property news that's happened over the week. Hi, Andrew.
Yes, good day, Michael. And as we sort of consistently say on the show, it does seem like Groundhog Day all over again, doesn't it?
Yes, it does. And I guess it was fueled because since we last chatted, the Reserve Bank's delivered the third consecutive interest rate increase at their July meeting, but that was widely expected. And the headlines are scaring Australians. They're saying things like a triple whammy from the RBA with 3 interest rate rises in 3 months. But Andrew, interest rates are still below neutral. In other words, they're still stimulatory, which means we're going to have more rates moving forward. And that's going to put pressure on mortgages. But it doesn't seem that there's any mortgage stress. I think the real issue at the moment is confidence, isn't it?
Well, that's right, Michael. So it's the sizzle rather than the sausage that's causing all the alarm at the moment. And we do see that. This is just a revisit of the clickbait house price crash headlines that we've had in the past. And interestingly enough, the impact on confidence doesn't last because, as you said, the fundamentals are still quite strong, not just for the economy, not just for household balance sheets, but also for the housing markets. But they're cheap headlines, Michael. We've seen it all before. The forecasts by the banks for these horrific falls in house prices were made in 2018. They were clearly wrong then. They were made at the beginning of COVID in 2020. They were clearly wrong then. And I believe that the same hysterical headlines will be clearly wrong again. But the history lesson is clear that there is absolutely no foundation for these numbers. And if anything, our markets and our economy and our household budgets are in better shape now to cope with higher interest rates than in any other tightening period that we've had. So I don't know what the fundamentals are that particularly the bank forecasters, who you think they'd be pretty good at housing market insights, wouldn't you, Michael, given that's their bread and butter in terms of their business. But by geez, they get it wrong so frequently. And we'll wait and see if yet again the bank forecasters are completely wrong.
Well, again, let's be clear. We're not suggesting that property values always increase. And I want to, in a moment, have a look at what's happened in the past. And again, I know we both agree that the Sydney and Melbourne markets in particular are already falling and will continue overall, while there's certain segments that are doing well. But other parts of the Australian property market are doing well. Now, sure, there's negative influences. There's rising inflation, there's cost of living pressures, there's reduced borrowing capacity because of rising interest rates, and high prices and the lower wages growth is causing affordability constraints. And yeah, there's uncertainty about the economy. But as you were saying a moment ago, Andrew, there's so many positive factors. International migration is picking up. There's such a shortage of properties and a decline in building approvals, virtually no vacancies. Listing volumes are at 30% of 5-year averages. Our economy is still growing, low unemployment, wages are starting to go up, strong household balance sheets. It's been suggested that we've got somewhere between 250 and 260 billion in aggregate savings. And the banks are doing well. Just weekend, the Commonwealth Bank Chief Executive Matt Comyn came out to say that 3/4 of the CBA's loans are 2 years ahead on repayments on average. And we know that construction costs are rising, meaning the replacement costs of properties are going to rise. Government incentives for first-home buyers. I could go on and on. As you say, boy, are the fundamentals strong.
Absolutely, Michael. And the reason we're seeing declining prices currently, because affordability really hasn't made an impact on the market, is because of inaction. It's just a market that's sitting, waiting and watching, as we saw in 2018 into 2019 when similar fear campaigns were up and running. And it's exacerbated, of course, because this time of the year, we're always a little bit inactive because of the winter selling season. So this has been exacerbated by increasing interest rates and the headlines that come with that. But there's a journey now underway. The Reserve Bank rates will continue to rise. The US was hoping that it was starting to see early signs that higher interest rates were impacting the economy. And of course, you've got to remember the US went earlier into its tightening cycle than Australia. But it again, at the end of last week, the numbers for June were sobering for those that were hoping monetary policy was easing activity, because jobs growth was still strong in the US over June, and wages continue to rise strongly in the US, which is bad news for inflation. So the Reserve Bank, the Fed will obviously now be again supercharging those interest rate increases, probably another 0.75% increase, because whatever they're doing now isn't working. And unfortunately, there's now increased predictions, even though we've seen some easing in the price of oil over the last fortnight, Michael. There are now increasing predictions that the price of oil is going to escalate again over record levels. And there are policies now designed to actually, assuage the Russians in terms of putting a floor under Russian oil prices. So the geopolitical issue is now, working its way to conflict with the economic issues that are arising, particularly because of the price of oil. So our interest rate regime is set to continue to increase, Michael, and in Australia, of course. That means higher rates, but we just got to get used to that environment to some degree. And maybe in some respect, if our economy can continue to survive higher rates, that we'll become a bit more confident about the outlook.
Property values are affected by lots of factors, not just interest rates. I went through some of the positive factors a moment ago, but let's look at what's happened in the past, because from what I understand, there's never been a fall to the magnitude that some of these predictions are suggesting. And our economic conditions, the fundamentals, are nowhere near as bad as they've been in the past.
That's right, Michael. In fact, if we look at the ABS house price series for the national capital city price aggregate, we can see that the worst year-on-year performance, that's December quarter to December quarter performance nationally in the modern era, has been 5.5%. So that's the worst decline in house prices from December to December, according to the ABS series. And that was recorded in 2018, Michael. As I said, that was a period of following a very strong period of prices growth. And that was, again, a period where confidence was affected by a lot of negative headlines. But if we look at the peak to trough declines in house prices, which gives us the length, not just the annual declines, but the total length of decline from the peak of the market to the trough of the market. But we can see from that ABS data as well that the most significant decline in house prices nationally from peak to trough was from December 2017 to June 2019, which is a period of 18 months, and prices fell there by just under 10%. So the worst record we've had is around 9.9% peak to trough, and that was over a period of 18 months, Michael. So these predictions just don't hold up in terms of the historical experience.
So if we put all this together, where do you think values are going to be by the end of this year?
We've obviously got still a two-speed market, with the smaller capitals, Michael, still growing but easing from their very strong results of the past year. And that's because affordability is sidelining buyers. There's nothing unusual about this. It's just that Sydney and Melbourne came earlier into the boom cycle, so affordability barriers have acted to ease that. That's being exacerbated now by lack of confidence. But I think over the year, we'll see Sydney and Melbourne prices decline by around about 6%. I think that we'll see still strong growth in Adelaide and Brisbane, up around 10 to 12% over the year in Brisbane and Adelaide. And in Perth, I think we'll see prices up around about 9%. So if we put that all together and produce a weighted price nationally, I still think we'll see the national house price increase by around about 1% over 2022, Michael. So reasonably flat. But there's a long way to go to get to those 30% falls that have been predicted if we're still going to see at least steady prices growth over 2022, even though our bigger markets obviously are tracking backwards. But even if we take into account the 6% fall in prices that we can expect in Sydney and Melbourne this year, we can still look back at the end of this year over the past 3 years, and Sydney and Melbourne house prices will be up between 30 and 40% over the 3-year period prior to the end of this year. So it's not exactly doom and gloom in terms of how markets properties have increased over the last 3 years, even with falls this year.
The markets are doing what they always do. They behave cyclically, and consumers are also doing what we always do. We behave irrationally and we allow fear and greed to drive our decisions. And unfortunately, what's currently happening is that fear is more prevalent than greed, the worry about buying too early, paying too much, what's going to happen. But eventually, those emotions are going to swap and life's going to get on. People are just going to make their home decisions, their buying decisions because of their lives moving on, Andrew.
Yes, and that's the whole point is absolutely 100% correct. The rational end of the market will start to re-emerge, and that's because there will clearly be good buying opportunities emerging, and those value perceptions will start to readjust in the market. We have the strongest economy in our history at the moment in terms of unemployment. Wages, according to the Reserve Bank, are now pushing above 3%, high savings levels, plenty of incentives. Going forward, once the standard underlying drivers of housing demand, and notwithstanding the outside drivers from migration, but we need a bigger house, a smaller house. We're moving to the bush. We're moving to the beach. All the factors that eventually decide property decisions will start to override the fear factor. Because when we realise again that the roof's not falling in on our housing markets, we'll be off and running. And it'll be in an environment where prices have eased. So there will be those good value opportunities emerging yet again, as we saw in 2019. And, eventually, once we do get our interest rate position consolidated, whatever level that might be, it also means that if we have eased economic activity, that the Reserve Bank then will start to think about cutting interest rates, which will improve affordability. And as you said, Michael, that's just the cycle reinvesting itself once again.
Now, one of the things I look out for is home loan approvals, because that's a leading indicator. People get their loans in readiness to go into the market. And recently, home loan approvals, while they've clearly come off their recent highs, investor approvals have actually increased. And the other interesting thing, of course, not surprising, is the proportion of fixed rate loans taken out has dropped considerably, hasn't it?
The overall position, Michael, is still at high levels, but a flattening home loan environment. Now, of course, higher interest rates will act to push some buyers out of the market because of affordability issues. But we certainly, to this point of time, haven't seen any sharp declines in home loan approvals. There's positives out there, particularly for investors who'll be chasing those high rental returns, which are continuing. And of course, there's lots of stimulus packages for first home buyers out there to take advantage of. And they'd certainly want to be they'd be looking very carefully at the rent versus buy equation with the tightest rental market in our history at the moment.
Well, with the tight rental market, as we've kept mentioning, there's very few new dwellings coming out of the ground. Those big developments just aren't financially feasible at the moment. But once again, last month, dwelling approvals rebounded. But that had more to do with the apartment approvals. And Andrew, they're very lumpy because they come in big waves and then all of a sudden nothing much happens. And by the way, just because development approval occurs doesn't actually mean the building's actually going to come out of the ground, does it?
No, and the underlying trend is still downwards for both apartments and houses, Michael. We're still well short of anywhere near the houses that we need to satisfy demand. That's not going to change anytime soon. And of course, we've got the extra problem for developers is high building costs. And there's no sign of an easing in building costs. My latest building cost index, which covered that latest ABS data, has actually showed an increase in the rising trend of building costs. So that's not easing at the moment, Michael, and that's going to make it more problematic for developers, given not just the uncertainties, but also the higher costs now involved with development. And of course, perhaps the spectre of a market that's in the short term certainly spooked in terms of buyer activity.
Well, recently, Australia's biggest property developer, Harry Triguboff from Meriton, suggested for new developments in the towers, the sort he's building to become financially viable, the end value of units is going to have to increase 20%. Clearly, the market won't pay that at the moment, but developers aren't going to start building until they can make their developments financially viable. Banks won't lend until that happens either. So the next round of construction is going to be much, much more expensive. That's going to pull up the value of apartments. Currently, the gap between apartments and houses is the biggest it's been for a long time. So I can see with affordability issues, apartments are going to, well, the right sort of apartments, the family-friendly apartments are going to perform well moving forward.
The big picture is we're just, even an environment where we're clearly short of housing, it's going backwards, not forwards, Michael. We're building less, but demanding more. So that can only mean higher rents and higher prices eventually once we move into a balanced position in terms of our interest rate position. But regardless of interest rate movements, tenants are still going to have to be paying higher rents going forward. And we've just got no real prospect of replacing what we're losing in terms of the net position for dwellings. And this, of course, will be exacerbated by waves of migrants that are heading for our shores, and students and business travellers, tourists. Not sure what the government's doing about this, but by geez, they need to do something, Michael.
Yes. Now, every Sunday you report the auction clearance results, and differently to others because you break them up by state, you break them up by houses and apartments. That makes a difference, and even by region. So I follow your LinkedIn profile every Sunday, and we republish those on Property Update. But the auctions are giving us a good indication of how people are feeling at the moment, and clearly auction clearance rates are falling, Andrew.
Yes, Michael, and they've probably held up a little longer than we would have expected given a lot of negativity. But of course, auction listings are backward looking because they're programmed 6 to 8 weeks before they're actually auctioned. But we are starting to see, particularly in Melbourne and Sydney now, sharper declines in auction clearance rates. The numbers are also quite low in terms of listings. Sydney's holding up to some degree in terms of listings. And let's remember also, it is the school holiday period. So this is always a quieter period for auction markets, not just for volumes, but also for buyer activity. But the Melbourne market certainly has dropped away sharply in terms of what we would expect for auction numbers. I think to some degree that's been helping its clearance rate because there's been fewer choices for buyers out there. But it is a market, firstly, a midwinter market, which is typically quieter. And it's a market also where there's a lot of uncertainty, and buyers and sellers will sit on their hands until that becomes stabilises the fear in the market. But other markets also starting to look a little more fragile. Canberra, which is at a performance similar to Sydney and Melbourne. But the Brisbane market is also starting to ease after being extraordinarily strong over the past year. But Adelaide keeps holding up, Michael. Adelaide's the superstar at the moment in terms of housing market activity. Volumes are high, clearance rates are still high, and still quite obviously a seller's market in Adelaide, but no real surprises with the rest. We are starting to see other signs of doubt in the auction market, Michael. We're seeing higher numbers, marginally higher numbers of withdrawals, particularly in Sydney and Melbourne and Brisbane. And also we're seeing agents that are reporting auctions, but not for publication. So that's a little bit of human nature there, where agents are happy to report the results, but they don't want them published. So there's sort of a background. We only produce published, fully reported auctions, so there's no doubt as to the nature of the numbers, but we typically have a wider net to cast out there. But that's why some of those clearance rates around are lower, because they're taking account of properties that have been reported but are not published, the actual property itself. That gives a little bit of doubt to the equation under those circumstances, but there's no doubt, regardless of the methodologies used, that the trend is certainly falling away. We're still not back yet to where we were at the end of 2019, and 18, Michael. So maybe there's a little bit more confidence in the market than then. And I think a lot of that has to do with a stronger economic position, as we've sort of discussed today, and also a stronger position in the housing market.
Also, I think people are more confident about their jobs at the moment than they were in those times. But we're going to keep tracking them regularly, and we're going to keep catching up once a week to have these regular discussions. Thank you for giving us some clarity, and that we don't have to worry that the sky's falling and the roof's falling on our heads. Look forward to catching up next week, Andrew.
Thanks, Michael.